Chapter 9, accounting for current liabilities. How would you define a liability?
I would is like something you have to pay out, like something that you can't count as an asset doesn't necessarily help your business in that way. If that makes sense.
Okay, you definitely can't count it as an asset because it is not an asset.
Debts.
Recall that basic accounting equation. Compared to assets, where do you find liabilities?
On the other side of the equation?
Yes.
On the other side of the line. So we definitely wouldn't call it an asset.
Mm-mm.
I would define a liability as a probable future payment of assets that can be cash or services that a company is obligated to make as a result of past transactions or events. Now, based on this definition, I'm going to include 3 crucial factors: a past transaction or event, a present obligation, or a future payment of asset or services. We classify liabilities between short-term and long-term. Short-term, also called current liabilities, are obligations due within 1 year or the company's operating cycle, whichever is longer. So if you have an operating cycle less than 1 year, we're going to fall to a 1 year as defining current liabilities. Current liabilities are expected to be paid using current assets or by creating other current liabilities. So we can give me an example of a current liability.
My car.
Car payment.
I own it, but I owe on it.
Your car, what you owe on it. Let's put our corporate hats on.
Oh, I don't have a good corporate hat. Equipment that you purchased but you don't own yet.
Well, yeah, that.
Payment on land. Mortgages on your land.
Why do each of you report to work?
For a paycheck.
Or a paycheck? Wages payable.
Wages payable. Okay.
Accounts payable.
Mm-hmm.
Utilities payable.
Short-term notes payable. What must you pay every April 15th?
Taxes.
Taxes payable. Right now, a company's obligations not to expect it to be paid within the longer of 1 year of the operating cycle, we're going to report as long-term liabilities. Examples of long-term could be notes payable, again, warranty liabilities, lease liabilities, bond payable. So again, if we're not expected to pay it within the short term, we'll classify it as long-term. So when you use the example of equipment, those current payments, again, if we were going to pay on it within that 1 year period, yes, that portion of it might be. Now, what I point out is that when you see, remember, what's the key phrase that you can look for?
On credit.
On credit, but what's accounts receivable? I would you classify accounts receivable?
An asset,
An asset. Accounts payable.
a liability.
Wages payable.
Payable. Debt, liability,
So what key phrase are we looking for?
payable.
All right, so I would point you to the word payable. I'd also point you to the word of unearned. All right, so here's a slide showing us current long-term liabilities for some companies here in the United States.
Can you share that screen?
How's that?
Perfect.
All right, so we'll see here, relationship from current liabilities to total liabilities. Six Flags, which is a theme park, Bowl America, Apple, even Columbia Sportswear. Amusement park, let's just say entertainment, technology, and retail. You know, I could be trying to see if I could find any similarities here. Again, Six Flags to Bowl America, did not seem to be any type of relationship there, but as far as industry specific, but industries that would be tied up with, again, long-term debts, long-term liabilities, probably would be more of company specific versus long-term. Now, I'll point out that a single liability can be divided between the current and non-current section. Again, think of the capital expenditures. If the company expects to make payments toward it, both in the short term and the long term. The items that you were expected to pay in the short term, current account. Those payments that were expected to be made longer than 1 year fall under long term. Uncertainties of liabilities. When we account for liabilities, we address three important questions: whom to pay, when to pay, and how much to pay. Now, the answers to these questions are going to be decided most often whenever the liability is incurred. For example, if a company has $100 accounts payable to a specific individual, payable March 15th, the answer to that's pretty clear. In that situation, you know whom to pay, when to pay, and how much to pay. However, the answers to some of these are going to be uncertain. All right, now here are some examples of known liabilities. We covered these. Accounts payable, sales tax payable, unearned revenues. All right, now pay attention again. Here we see that payable and unearned. Short-term notes payable, payroll liabilities, and multi-period known liabilities. These would be the ones that are going to fall between two accounting periods.
An example, what do you example?
An example of one would be if we purchase some equipment or we made a capital purchase And again, we were going to start making payments on that, and we were going to make those payments for 5 years. The payments that we were expecting to make within that first year, I'm going to assume we're operating on a 1-year financial cycle. The payments we were expected to make in that first year would fall under current.
Yeah.
And then payments that were expected to be due years 2,
3, and 4.
3, 4, and 5 would fall under non-current or long-term.
Okay.
Now, sales tax payable. Let's look at an example. On August 31st, Home Depot sold materials for $6,000 that are subject to a 5% sales tax. All right, what are we debiting?
Cash.
Cash.
Yeah. We're debiting cash $6,300. Okay. So if we are the retailer, that's the amount of cash that we would receive, or that's the amount that our cash asset would be increased, $6,300. Now, what are we crediting?
Sales and sales tax payable.
Sales and sales tax payable. Sales tax payable is debited. It's important too. Sales tax payable is not an expense. It arises because the law requires seller to collect this payment from customers on behalf of the government. I have a little side injection there. And FYI, I will say, it has no bearing on this accounting right now. But your cash asset would increase by $6,300. Sales would be credited for $6,000. Sales tax payable credited for $300. Unearned revenues. Sometimes instead of the word unearned, you might see these reported as deferred revenues. You could see them called collections in advance. You could see them called prepayments. Okay, so these are going to represent amounts received in advance from customers for future products or services. So we've already received, but yet we have to settle. So advanced ticket sales for sporting events. Let's use this as an example. Rihanna sells $5 million in tickets for 8 concerts. She has sold these tickets in advance. What are we debiting?
Your cash.
We're debiting cash by $5 million and crediting unearned ticket revenue. Now, on October 31st, she performs a concert. We must now pull that amount out of unearned ticket revenue and report it as ticket revenue. So here we are reporting that we have earned or satisfied this service. Unearned revenues can arise also with if you purchase airline tickets, magazine subscriptions, hotel reservations, gift cards. Now, here's one from a multi-period. All right, so unearned revenues for magazine subscriptions often cover more than one accounting period. A portion of the earned revenue is recognized each period, and the unearned revenue account is reduced. Now, notes payable extended over more than one accounting period. As an example, a 3-year note would be classified as a current liability for 1 year and a long-term liability for 2 years. So just remember, whatever amount is going to fall in the greater of 1 year, company's operating cycle would be classified as current. What's a short-term note payable?
Payable that you pay a specified amount on a definite future date within 1 year, or the company's operating cycle, whichever is longer.
Good. All right, this is a promissory note, just like a check. And what that means is they are negotiable, meaning they can be transferred from party to party by endorsement. The written documentation often with notes payable is helpful in resolving disputes and for pursuing legal actions against these liabilities. Most often, notes payable are going to incur interest to compensate the lender for the money lended until payment is made.
What company's operating cycle? Can that be like 18 months instead of 12 months, which is a year? So it says whichever is longer. Does that?
No, we're not going to assume you have a marketing or an operating cycle longer than 1 year. I don't know an example of when you
Okay.
would. Just because a lot of these items are going to come due, if nothing else, you must file that tax return on an annual basis. Operating cycle. You know, if anyone was closed for summer or closed, so some people just operate.
Closed for the winter or stuff like that.
Yes, could be seasonal or some calendar base. I'm thinking of sports right now. All right, a note given to extend the credit period. All right, sometimes a company that purchased merchandise on credit can extend the credit period by signing a note to replace the accounts payable. Here's an example of that. On August 23rd, Brady asked McGraw to accept $100 and a 60-day 12% $500 note to replace its existing $600 accounts payable. How are we accounting for this?
So you're taking it out of accounts payable?
And replacing it with that note. So accounts payable, are we reducing it or adding to it?
Well, you're kind of reducing it.
We are reducing it. We're pulling it out of accounts payable. We're replacing it.
But why would you move a balance? I mean, it's essentially moving a balance. You are lowering it, but it's still a payable, so it's still, why would you move it?
How would you move it?
Why would you? Why wouldn't you just debit accounts payable?
We are debiting accounts payable.
No, I mean, why wouldn't you just debit accounts payable 100 and credit cash 100? Why would you move it to notes payable?
Okay, if you did what you said, would your equation be in balance? If we debited accounts payable 600 and credit cash 100.
No, I know that wouldn't balance, but that's what I'm asking. Why wouldn't you just debit accounts payable 100 for your payment and credit cash 100 because you're paying it?
Why are we moving from accounts payable? What's the difference between accounts payable and a notes payable? Is it the percentage of interest?
Well, the notes payable is they're giving them a 60-day credit.
Oh, think about it that way. Okay.
Okay, imagine you receive a bill. You would typically have one month max to pay that bill. You're reclassifying this liability.
Okay, so they're giving you a longer amount of time to pay it at a higher percentage if you don't?
This is what they're asking for. So they're asking to reclassify it as from an accounts payable to a notes payable. And for that, they're going to offer $100 in cash, and they're going to pay that 12% interest.
Okay.
So basically they need more time to pay it,
This would be an example of yes.
even though they're paying
Okay.
more, essentially.
Remember I said you could find this. A company might purchase merchandise on credit. Okay, that's going to be the accounts payable. But often find the need to extend that credit period. There could be a cash flow disruption. There could be a cash flow slowdown.
This is how it's done.
So they're signing a note to replace the accounts payable. They need more time to pay it.
Okay.
You find this really often when borrowing money from the bank. Why you would move it from accounts payable to notes payable, again, it's two different types of liabilities. Each has a different meaning to it. All right, now on October 22nd, Brady pays the note plus interest to McGraw. So now, what are we debiting?
The notes payable.
The notes payable,
And the interest.
plus we get the interest.
Mm-hmm.
And we received $510 in cash. If you look at the interest expense, I'll point out $500 multiplied by 12% multiplied by 60 divided by 360. If in your homework, since this is presented to you using 360, I would suggest you use that if trying to calculate a specific daily amount of interest. If you find that answer is not correct, try it with 365. Using the 360 is an old dated accounting shortcut, and I say dated. I've heard it even pre-exist calculators. Back when individuals were doing this by hand or in their head, accountants found it easier and more convenient to divide by 360 than keeping it 365. You sometimes still see that in finance and accounting still using. I would say to a lesser degree, since most of this is technology driven right now. All right, note given to borrow from a bank. Here's what this promissory note's going to look like. So if you went to the bank, or a company goes to the bank to borrow money, nearly always the bank's going to require them to sign a promissory note before they make the loan. When the note matures, the borrower will repay the note with an amount larger than the amount borrowed. The difference between the amount borrowed and the amount repaid is the interest. Now the signer, Janet Lee, is going to promise to pay principal or the amount borrowed. In this case, we're going to assume Janet needs $2,000 to complete a project. So she's going to go into the National Bank of Boston, sign a promissory note stating she needs to borrow $2,000 and 12% annual interest. Okay, the note's made on September 30th and is due in 60 days. So essentially, Janet's making the statement, I promise to pay $2,000 plus 12% interest within 60 days after September 30th. This is the bank's record. And again, this is signed as a way to, if Janet defaulted or did not make a payment, again, this is the bank's record that would be presented in any type of legal proceeding or any type of recovery proceeding. All right, so on September 30th, the company borrows $2,000 from a bank at 12% interest for 60 days. How are we going to record this? We sign our promissory note. Okay, so on September 30th, is our cash increasing or decreasing?
Increasing.
Increasing.
Increasing, therefore we're debiting it, $2,000, and we are going to credit notes payable. We owe that money, it is a liability. Again, we will put this little description, short description under notes payable, borrow $2,000 cash with a 60-day 12% $2,000 note. Now, when we actually make the payment on November 29th, we need to make this second entry. So here we are going to record notes payable plus that interest expense. And then we are paying with cash. So our cash is decreasing. To decrease the asset, we will credit it. All right, now here we're going to see an example of end of an accounting period. So the end of the accounting period is going to fall between the signing of the note and its maturity date. Now make note of the expense recognition or the matching principle is going to require us to record the accrued but unpaid interest on the note. All right, to illustrate, let's look at this example. On December 16th, 2015, a company borrows $2,000 from a bank at 12% interest for 60 days. And we're going to need to make an adjusting entry on December 31st. Okay, so on September 30th, here's what we saw prior. We borrowed $2,000, so we're going to debit cash $2,000. We've already credited notes payable $2,000. And then on February 14th, the company repays the principal and interest on the note. Debiting notes payable $2,000, interest expense $40. We pay for this with cash. Looks like a delay, looks like an error here in the reporting date. In the example cash, though, we're going to credit $2,040. And again, I see this example of 360 days. We'll look at some problems here later. All right, let's help you better understand your paycheck. Payroll liabilities. Can you believe that your employer incurs an expense and a liability by hiring you? In all seriousness,
I'm an asset. I'm sorry.
you're an asset.
I'm an asset.
Hey, I have no doubt.
I'm telling you what, I'm an
I
asset.
have no doubt. Employees are an asset. In my opinion, are the most important asset. But still, they must be paid. And often, they must be paid. And often when you see the liabilities that occur here, they're going to be large. When you factor in wages and you factor in employee benefits, and taxes that you owe on these employees. Okay, so federal income taxes, state and local income taxes, and then your net pay. All right, so gross pay is where we're going to start. That's the total compensation an employee earns. This is going to include wages, salaries, commissions, bonuses, and any compensation earned before deductions. Taxes being an example. All right, and when you use the word wages, wages are usually used to report payroll based on an hourly rate. Now, we're going to use the phrase salaries to refer to payments to employees at a monthly or yearly rate. So we have our gross pay, and then we must pay taxes, and then we have net pay. Payroll deductions or withholdings. These can be either mandatory or voluntary. So out of net pay, you have any of your voluntary benefits. Okay, these are, voluntary deductions or benefits. These are at your option and can include any type of retirement plan, contribution, health insurance contributions, life insurance premiums, union dues, charitable giving, all examples that I see. Social Security taxes and Medicare taxes, these are mandatory and required by the result of law. FICA. So FICA taxes on Social Security and FICA taxes based on Medicare. These are 6.2% of the first, on Social Security, 6.2% of the first $117,000 earned in the reporting year. Okay, so the law is going to require employers to withhold this amount from your pay to cover costs to the system. Both of these are entitlements protected by the United States Constitution and benefits that we all may draw from, or at least are entitled to draw from. FICA on Medicare, 1.45% of all wages earned in the year. So there is no earnings limit here. Now I can share with you these are still the current rates right now. Some employees were able during this time period to receive a temporary reduction in the FICA taxes, but these have been 6.2% for some time now. Everyone know what Social Security and Medicare are?
Sort of. I mean, I'm going to be learning about Medicare like more in depth, but
Social Security, you know what that is?
I know that goes towards retired people.
Goes toward retired people. All right, Social Security system. It's going to provide monthly cash payments to qualified retired workers for the rest of their lives. And it's qualified because what you receive is based upon what you pay into the system.
Mm-hmm.
Medicare.
It's a form of health insurance or health. Yeah, I guess it's considered that.
All right, Medicare going to pay for health insurance premiums for the elderly. Not to be confused with Medicaid. All right, employee income taxes. Okay, these amounts are going to depend on your employee's earnings, tax rates, and number of withholding allowances. So when you were first, Taylor, you just received or you just got a new job.
Yep.
And I'm going to guess that your employer had you complete the number of withholding allowances.
Did that today.
Okay. So federal income tax is based on your employee's earnings, tax rates, and number of withholding allowances. And employers must pay the taxes withheld from employees' gross pay to the appropriate government agency. You can't hold on to it. So your employer keeps and withdraws that from your paycheck. They are under some obligation to that appropriate government agency on when they must submit these payroll taxes.
So what if somebody absconds with that money and doesn't pay it in? Who ultimately is responsible for paying it? Would it be the employer? Or is it going to come back on me and say, well, sorry, you didn't pay it, so you got to repay it?
If that was not paid, it would not take long before the employer was notified by let's pick on the federal government. The IRS would notify real quickly money has not been received. They would want an explanation. They would demand an explanation.
The guy's gone to Rio for the Olympics and has no intentions of coming back, and he's taken the money somehow. It's continuing to go after. I'm curious.
There would be some insurance premiums, or it would just be not paid into the system.
Okay.
If you were if the employee was unknown that money was not being forwarded, I would not see that government agency coming to you to pay. I mean, essentially, that would be, a theft.
That's why you bonded that employee that went to Rio to see the Olympics.
That's why you would bond them. Okay, so now once the employee withholds this from your tax, when they withhold it from your paycheck, this is going to be reported to them as a current liability on the balance sheet. They're expected to pay that in the short term. About the longest period I know employee federal income taxes would be small businesses sometimes report and pay on a quarterly basis. If your payment is large enough, you could even have a monthly deposit schedule. So at most, If you're the employer, you're withholding it from your employees, at most, you're gonna hold on to it for 90 days.
So they're continually pushing it out there to the government.
Correct. On the quarterly schedule, it is due 30 days after the end of the reporting quarter.
Oh, okay.
So by April 30th, you
You're paying
would
for the
file
first
and pay for the first quarter.
Okay.
All right, so voluntary deductions, again, we gave some example. And again, until these amounts are paid, they're going to be reported as the employer's current liabilities. All right, let's look at a record of recording a payroll expense. Okay, so your gross pay, salaries expense, $2,000. Now we are going to deduct the FICA, Social Security, FICA, Medicare, the employee federal income taxes that were withheld, employee medical insurance, so here's what you've authorized to be voluntarily withheld, union dues, and your net pay or salaries payable, $1,524. Now the employer payroll taxes. So in addition to those amounts that the employer withholds from you, with FICA, Social Security, and FICA, Medicare, the employer must also make payments. Now for 2014, remember, your employer withheld 6.2% of your federal taxes. The employer must match that and pay 6.2% on the first $7,000 of wages paid to each employee. You'll often see this acronym FUTA, F-U-T-A, and SUTA, State Unemployment Tax. So in addition to what your employer is withholding, they must also make those FICA taxes. Remember that, they must also make FICA payments on your behalf and Medicare. So whatever you are paying into Social Security and Medicare, your employer is matching that dollar for dollar. Your employer is also paying these federal and state unemployment taxes on you. In that same example, payroll taxes. This person does not have a very high. Okay, excuse me, I thought that was going to be payroll of 273. So the total payroll tax for the employer for the month of January was $273. And again, we see how we can break this down through mandatory FICA and Social Security plus federal and state unemployment. All right, let's go back to here. Estimated liability. So remember, thus far we have looked at only known liabilities. But an estimated liability is a known obligation, so we know we're going to owe something, but it's a known obligation of an uncertain amount, but one that we can reasonably estimate. Okay, anybody think of an example of this?
My home equity loan. Because every year it could go up, the interest rate.
It's variable?
Yes,
Okay,
yes.
okay.
So each year, if that rate goes up, or during the year, a minimum payment can go up.
Okay. Can you think of one from the business?
An insurance premium?
Insurance premiums, great example. We know right now health insurance probably going to go up. Okay, so based off of some past transaction or current industry trend, we can probably get an estimate of what that amount might be, but we couldn't pin it down to be exact. All right, so pension or medical insurance premiums. Pension deposits or insurance premiums. So here's an example of an employer agreeing to pay for medical insurance equal to $8,000 and contribute 10% of the employee's gross salary to a retirement program. All right, so what are we accounting for this? It's year end. What are we debiting?
The employee benefits expense.
Okay, and of that $20,000, 8% would be credited going into medical insurance payable. So we're going to make $12,000 or 10% of $120,000, $12,000 into the retirement program. Vacation benefits. I'm going to assume an employee earns $20,800 per year and earns 2 weeks of paid vacation. And what's their weekly vacation benefit expense? $16. Their average weekly wage would be spread over 52 weeks in the year, $400. But if we spread that over the vacation, deducting 2 weeks, we get $460. A bonus plan. I'm going to first assume you're fortunate enough to get a bonus plan. All right, now you're going to get a bonus plan to be paid to employees equal to 5% of the annual net income, $210,000. So to calculate this, let's set up the basic bonus equation. B is going to denote bonus. And your pre-bonus net income is $210,000. And your bonus is equal to 5% of this net income. A warranty. Seller's obligation to replace or correct a product or service that fails to perform as expected within a specified period. Okay, back to this matching principle, the seller will report expected warranty expense in the period when revenue from that sale is reported. And this can be substantial. Ford Motor recently reported nearly $8 billion in dealers and dealers' customer allowances and claims in its most recent annual report. So, can be looking at a big example. On December 1st, 2015, a dealer sells a car for $16,000 with a maximum 1 year or 12,000 mile warranty covering parts. We're going to rely on past experience to indicate a warranty expenses average of 4% of a car's selling price. So in the reporting period, December 1st, we recognize the $640 warranty expense. Remember, the warranty expense must be estimated and recognized within the same period. Due to the matching principle, it must match the period in which the revenues were earned. Now, on January 9th, in the new year, the customer returns the car for repairs, and the dealer replaces parts costing $200. So in 2015, we were estimating $640. And we credited estimated warranty liabilities. In the new reporting period, we find that the repair is only going to cost $200. So we recognize that repair for $200. We must pull that $200 out of our credit. So in order to do that, we will debit estimated warranty liability for $200 and credit inventory for $200. Who can tell me what a contingent liability is? Using your best words.
It's a liability that you're going to incur in case certain events happen.
Correct. A potential obligation that depends on a future event arising from a past transaction or an event. Good example is going to be a lawsuit. So in this example, a past transaction leads to a lawsuit. So future payment of that lawsuit is going to be contingent on whether or not the event occurs. Accounting for contingent liabilities is going to depend on the likelihood that the event will occur and the ability to estimate the future amount owed if this event occurs. 3 different possibilities are identified in this chart. We see the recording of the liability, the disclose in notes, or no disclosure. If the event is probable, we're going to record the liability. Possible, we are just going to disclose it in the notes. If it's a remote possibility, no disclosure is required. Okay, potential legal claims or debt guarantees are both going to be possible contingent liabilities. All right, liabilities on a global view. Here we're going to see some similarities and differences between U.S.-based GAAP and the international reporting standards. Okay, how they're defined and characterized. We're going to see broadly similar between the two agencies. We're going to see some subtle differences, but similarities outweigh. Under known liabilities, both U.S. GAAP and the International Reporting Standard requires companies to record in a similar manner. And estimated liabilities. So when we have a known current obligation that involves an uncertain amount, one that can be reasonably estimated, both GAAP and International Reporting Standard are going to have similar treatment. Okay, the last thing I will show here. I take that back. No, this is the last thing I will show. A times interest earned ratio. Okay, to calculate a time interest earned, I'm going to take income before interest and income taxes and divide it by interest expense. Now, I can say that companies that loan money want to assure that principal and interest are paid when it's due. Okay, so if you're in the business of lending money, you're going to use this ratio. And I'll have you make note that accounting experience has shown that when interest earned falls below 1.5 and 2 and remains at that level for several periods, defaults increase sharply. So if we see this ratio falling, and staying at that low level for several reporting periods, we're going to start expecting default. Now, opposite that, if income is stable or even growing, the company can afford to take on additional risk by borrowing. So assuming that income is growing and we see this ratio climbing, then the company might entertain additional borrowing. Briefly, how we estimate these ratios and how we define its use. What do we think?
It's not too bad.
Does it make you look at your paycheck, or at least your cost to employer, in a different light? And this leads me to believe that any of your employers present you with a total annual earnings statement?
Oh, yeah, yes.
Detailing all of these
Yes.
amounts?
What they're really paying you.
What they are really paying
Yes.
you. That can be eye-opening.
They include your what they're paying in your benefits for your health insurance and everything else. They added all that salary, and they're like, this is what we're really putting out and giving you. There it is, Alex.
Yeah, and if you get that statement, just compare that to your actual gross pay, compare that to your net pay. But still just looking at the difference between total compensation, or let's just say total compensation expense versus gross pay, you could see a noticeable difference right there. Especially if your company pays or subsidizes a larger portion of medical premiums, matching contributions toward retirement,
put that in there too.
or even if I don't know if any of you working for publicly traded companies, but if you were afforded stock options, or there's a difference there of what these can add up to. All right, let's look at some homework problems. Okay, so Google is not going to cooperate right now. Okay. So here's the textbook. I'll get back there. Okay, let me get back here. All right, let's look at the discussion questions first. And what's the difference between a current and a long-term liability?
Current is paid within 1 year, and long-term is after 1 year.
Current is expected to be paid in 1 year or the company's operating cycle, whichever is longer. Is everyone following the homework here on your own computers?
Mm-hmm.
Okay. Then what I can do is we will come back to this screen. What's an estimated liability?
A known liability in the future that you're taking in account.
Okay, it's a known, we know that the future payment is going to be required, but the exact amount of the payment
Is unknown.
be unknown. Let's look at quick study. Quick study 9.2. Dexter Company sells merchandise for $6,000 on cash September 30th. Cost of the merchandise is $3,900. Sales tax law requires Dexter to collect 5% sales tax on every dollar of merchandise sold. We're asked to record the entry for the $6,000 sale and its applicable sales tax. Also record the entry that shows the remittance of the 5% tax on this sale to the state government on October 15th.
Okay.
How do we solve this?
So we're debiting our merchandise inventory. There's going to be more than one entry, right?
Well, let's first, what's it asking us to do? Record the entry for the $6,000 sales and its applicable sales tax.
So you're gonna
So
do,
you sell merchandise for $6,000, and state law requires you to collect 5% tax.
So we're going to debit cash $6,300. Credit sales $6,000.
So debit cash for $6,300, and credit sales, you say, for how much?
$6,000. And credit sales tax payable $6,000 at 5% would be $300.
Good job. Now the second says to credit the entry that shows the remittance of the 5% sales tax to the state government on October 15th. So on October 15th,
You're gonna debit sales tax payable for the $300 since you're turning that into the government?
sales tax payable, I am going to debit $300. What is my offsetting entry?
Credit cash, $300.
Credit cash, $300. Good job. Let's look at problem. How do you feel about doing one such as 9.5? You're going to look at withholding. Feel okay?
Mm-hmm.
Yeah.
Okay. How about accounting for bonuses, vacations, or warranty repairs?
The warranties were kind of confusing.
Okay, so warranties would be 9.9. Okay, so question 9.9. On September 11th, 2014, Home Store sells a mower for $500 with a 1-year warranty that covers parts. Warranty expense is estimated at 8% of sales. On July 24th, 2015, the mower is brought in for repairs covered under the warranty, requiring $35 in materials, taking from repair parts inventory. Prepare the September 11th, 2014 entry to record the mower sale and the July 24th, 2015 entry to record the warranty repairs. Okay, so what do we know? Okay, so we've got a mower and it's sold $500 and the warranty estimated %8 of sales. And then when it's brought in,
$35.
$35. So I'm just gonna note this, realized at $35. Date of the sale was when? 9/11. When was it brought in?
July 24th, 2015.
July 24th, 2015. And it says to take this from repair parts inventory.
Go to the middle of the meeting.
Okay,
Here.
just make note. September 11th and 14, we sold the mower for $500. We estimate the warranty at 8% of sales, and then on July 24th, 2015, it's brought in and we cover $35 in parts taken from repair parts inventory. And we're asked to record these two entries. So, first thing I notice is that we have two different reporting years. So over here for 2014, September 11th. That's separate as our So what do we do on September 11th?
You need to record the sale of the item.
We need to record the sale of the item. We sold a lawnmower. What did I get in exchange for that lawnmower?
$500.
How much?
500.
500
Cash.
cash. So I'm going to debit it or increase it by $500.
You're going to do sales.
And then I would credit sales by $500. What else must I account for?
The warranty of the 8% of sales.
The warranty of 8% of sales. Remember, matching principle says that we must estimate and record the expected liability in the date in which the revenue is earned. So, warranty expense
40.
of 8% of sales, and my sales were $500,
It's $40.
$40. What am I going to credit? At this point, we are estimating it, so I'm going to call this estimated
Warranty liability.
warranty expense liability. It's important to distinguish that it is estimated. Now, in 2015, July 24th, customer brings the mower back in, and we repair it, realizing a cost of $35. And it tells us to take that from repair parts inventory.
So So it would be a repair expense?
Excuse me?
Would it be a repair expense and then,
Okay, now look right here. In 2014, we estimated warranty expense liability for $40.
so when you do that, that's the account that you have to debit when the warranty?
Now I have to debit. So estimated warranty expense liability, I'm going to debit $35. And it tells us to pull this from repair parts inventory. If we repaired it, inventory being an asset, if we pulled parts out of our inventory to repair it, we decreased that asset, therefore we are going to credit. Okay, so we have warranty repairs. How about times earned ratio?
Let's do one of those, please.
Times earned ratio is problem 911. Load it up. Okay, compute the times earned ratio for part company, which reports income before interest expense and income taxes at $1,885,000 and interest expense of $145,000. Interpret its times interest ratio and assume that its competitor's average ratio earned of 4. Okay, so let me clear the board real quick while you pull the data out of the problem. Okay, so what do we know?
So the income before interest and income taxes, that's the $1,885,000. So that would be the numerator. And then the interest expense of $145,000 would be the denominator. And then you just divide it to get 13%.
All right, give me 1 second here.
I definitely understand why it was this one. I don't get that. Well, principal times the rate of interest and time, but for the time.
So we know that income before interest and income taxes is $1,885,000. So income before
$1,885,000.
interest expense and income taxes.
13%.
Wait, no.
Is $1,885,000.
This one.
Yep,
Okay.
it was 13%. So, hey.
Interest.
And then the 145,000 is my interest expense is 145,000. Okay. Here's my no.
Mm-hmm.
How do I solve for the times earned ratio?
It's the income before interest and income taxes.
Which is
The 1,885,000. And then divide that by the interest expense, which is the 145,000.
and what do you get?
13%,
Not percent.
not percent.
It's a ratio, 13 times. Okay, now interpret that result for me.
That's what I was just about to ask.
Hey, what does it tell us? Our competitors are, was it 4 times?
What?
Yeah, assume that its competitors averages a times interest earned of 4.0.
Okay, so competitors are at 14, or excuse me, at 4, and we calculated 13. So 13 being far superior to 4. So what does a time earned ratio of 13 suggest? Well, at what level, go back and recall on that slide, what level did we start to find, what level did we start to see default risk increase?
1.5 to 2%.
1.5 to 2. We start to see defaults. So if we're at 13, we're even greater. Our industry is superior to this level. We're far superior. So if we have a times earned ratio at 13, it's going to suggest that we have sufficient income to cover interest obligations. And therefore, we might even consider taking on, if we were expected to have more stable and predictable income, we might look at taking on additional debt. We want to do another one?
Can we touch on the, I don't know, the time frame of the interest one more time? Because one of the homework questions was asking about interest earned in a year. And I didn't understand why it was the answer that it was.
What is the answer?
27 out of 360.
Are you asking why are they using 360?
Well, I realize that is the year, but why is the 27 there? Like, what does the 27 represent? The pay period? Or the time in between when each is due?
What's the homework problem? I need to see what context it's used.
It gives you a couple transactions, and it asks you about the maturity dates, and then you have to figure out the interest earned for each of the three.
So you're referring to the weekly homework.
Yes, I guess I'm just not sure in a specific problem why it was the time frame it was when it was asking about the year. So I guess I don't need that specific question answered, but maybe why one would choose 27 out of 360 versus 30 or 60 out of 360, especially when, I mean, the specific question is determine interest expense to be recorded in 2015.
How many days are left in 2015? Again, I need to see the problem, but based on what you just told me, is it something to do with the calendar?
So this one's what, problem 2?
Well, we borrowed the money from that bank on November 28th. So it would be 33 days until the end of the year. And then it's asking for 2015, which is the next calendar year. So that's why I was assuming it was asking for the whole year. Oh, I know why it is. Okay. So the first question was how much interest is paid the remainder of 2014, which was 33 out of 360. So the answer to the next question is 27 out of 360 because that's the difference in the 60 days.
Okay.
Okay. So yes, it has to do with the calendar.
Okay, anything else?
No, I think the example with the warranty was really helpful, as well as the first one we did.
Mm-hmm.
Okay. Well, again, thank you, and you'll be able to find this video on YouTube.